The hidden Social Security tax that's stealing $7,000 from your retirement every year. What if I told you there is already a cap on your Social Security, and it has been quietly draining your retirement income since 1983? Not the $50,000 cap making headlines right now, a different one, a silent one that does not limit what the government sends you. It limits what you actually keep. And for the average retiree in 2026, that difference is $7,000 per year. That is not a theory. That is not a worst-case scenario. That is the math. And by the end of this video, you will see exactly where every dollar goes, why the system was built this way, and the 5 proven strategies that can reduce that number to zero. Before we go further, nothing in this video is legal, tax, or investment advice. These are educational examples based on current IRS tax law and publicly available government data. Always work with a qualified tax professional for your specific situation. The tax nobody is talking about. Right now, every financial news outlet is covering the proposed $50,000 Social Security benefit cap. Social media is flooded with it. Retirees are outraged. And while everyone was focused on the cap that asterisk might happen, almost nobody noticed the cap that already exists. It has been sitting inside the U.S. tax code since asterisk 1983. It has been silently shrinking the real value of Social Security checks for over asterisk 40 years. And in 2026, it is costing the average retired American more than asterisk $7,000 per year. Here is how it works. The frozen threshold, the most powerful silent tax in American history. In asterisk 1983, the Social Security amendments created a tax on Social Security benefits for the very first time. The rule was simple. If your asterisk combined income, also called provisional income, exceeded asterisk $25,000 as a single filer, or asterisk $32,000 as a married couple, up to asterisk 50% of your Social Security benefit became taxable income. At the time, those thresholds were set high enough that only about asterisk 10% of Social Security recipients were affected. It was marketed, sold, and accepted as a tax on the wealthy. Then, in 1993, a second tier was added. If your combined income exceeded asterisk $34,000 as a single filer or $44,000 as a married couple, up to asterisk 85% of your Social Security benefit became taxable. At that point, roughly 18% of recipients were affected. Still a minority, still positioned as targeting higher income retirees. Now, here is the critical part, the part that should make every retiree furious. Those thresholds have never been adjusted for inflation, not once, not a single dollar in over 40 years. Every other major threshold in the federal tax code gets indexed to inflation annually. Tax brackets, adjusted every year. Standard deduction, adjusted every year. Capital gains thresholds, adjusted every year. Crossmark, Social Security taxation thresholds, frozen since 1983. The result? Every year, those thresholds stay frozen. More retirees cross the line. More benefits get taxed. More money flows directly to the IRS. The numbers tell the story. 1984, right-pointing arrow, 10%. 1993, right-pointing arrow, 18%. 2015, right-pointing arrow, nearly 50%. 2026, right-pointing arrow, estimated 56% and climbing. 2030, right-pointing arrow, projected to exceed 70%. A tax designed for the wealthiest, 10%, asterisk, of retirees now hits more than asterisk half of everyone collecting Social Security. That is not an accident. That is not an oversight. That is the feature. Every year, the thresholds stay frozen. The federal government collects approximately asterisk $45 billion more asterisk in tax revenue directly from Social Security recipients. The frozen thresholds are a revenue engine, and Congress has no real incentive to fix them. Where does the $7,000 go? The exact breakdown. Let's walk through a real-world retirement tax calculation so you can see exactly where the money disappears. The profile: age 68, single filer. Social Security benefit $24,852 per year, the 2026 national average, $2,071 per month. Traditional IRA withdrawal, $30,000 per year. Savings interest, $2,000 per year. Step 1. Calculate provisional income. The IRS uses a formula called provisional income to determine how much of your Social Security is taxable. Provisional income equals AGI plus tax-exempt interest plus asterisk 50% of Social Security. AGI, $30,000, IRA, plus $2,000, interest, equals $32,000. Half of Social Security, $12,426. Provisional income equals $44,426. Hash, hash, hash. Step 2. Determine taxable Social Security. At $44,426, provisional income, our retiree is above the asterisk $34,000 single filer threshold, asterisk, firmly in the asterisk 85% zone. The IRS runs a two-tier calculation. Tier 1, 50% of the amount between $25,000 and $34,000 equals asterisk $4,500. Tier 2, 85% of the amount above $34,000, 85% of $10,426 equals $8,862. Total taxable Social Security equals $13,362. That means $13,362 of a Social Security benefit, money already taxed through a lifetime of payroll contributions, is now treated as asterisk ordinary taxable income. Hash, hash, hash. Step 3. Federal tax on Social Security. After applying the standard deduction of $18,150 asterisk, including the senior edition, taxable income, approximately $27,214. Tax bracket, asterisk, asterisk, 12%. Federal tax on Social Security portion, approximately $1,603, asterisk, asterisk. Hash, hash, hash. Step 4. State tax. 8 states still tax Social Security benefits in 2026. Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. For retirees in those states, add approximately $500 to $530 in state-level Social Security tax on top of federal liability. Hashtag. Step 5. Medicare premiums. Medicare Part B and Part D premiums are deducted directly from your Social Security check before you ever see a dollar. Part B, $185 per month, right pointing arrow, $2,220 per year, asterisk, jumped 9.7% in 2026, asterisk. Part D, approximately $480 per year. Total Medicare deductions, approximately $2,700 to $2,915 per year. Hashtag. Step 6. The cascade effect, the hidden $2,000 plus. Here is the cost most retirement calculators completely ignore. Every dollar withdrawn from a asterisk traditional IRA increases provisional income, which pulls more Social Security into the taxable zone. If that same $30,000 had come from a Roth IRA instead of a traditional IRA, Roth withdrawals equals asterisk $0 added to provisional income. New provisional income, $2,000, interest plus $12,426, half of SS, equals asterisk $14,426 asterisk asterisk. That is asterisk below the $25,000 threshold. Result, asterisk asterisk, 0% of Social Security taxable. Tax savings, $2,133 per year, just from using the right account. Hashtag, the full annual cost. Cost category, annual amount. Federal tax on Social Security, approximately $1,603. State tax, taxing states, approximately $530. Medicare premiums, approximately $2,915. Avoidable tax from wrong account type, approximately $2,133. Total hidden annual cost, approximately $7,181 ***. Over a 25-year retirement, $179,525 gone * from a benefit you were told was yours. Hashtag the married couple reality. The numbers hit even harder for married couples. ***. The profile, both age 68, married filing jointly. Combined Social Security, $40,000 per year. IRA withdrawal, $25,000. Pension income, $12,000. Savings interest, $3,000. Provisional income calculation. Non-Social Security income, $40,000. Half of combined Social Security, $20,000. Provisional income equals $60,000, ***, well above the $44,000 joint threshold. Approximately $19,600 *** of their combined Social Security becomes taxable income. The annual cost. Federal tax on Social Security, approximately $2,352. State tax, if applicable, approximately $550. Medicare Part B for both, approximately $5,280 per year, after the 2026 increase. Part D for both, approximately $960. Total annual cost, approximately $9,100 to $9,740. They receive $40,000. They keep approximately $30,260 to $30,400. The hidden cap consumed nearly ***, 25% of their combined Social Security benefit. The COLA trap, how your raise becomes a tax trigger. Every year, Social Security benefits receive a * cost of living adjustment ***. In 2026, COLA was *** 2.8%***, giving the average married couple roughly $1,120 more * per year. Sounds like a win. Here is what actually happened. That COLA increase raises provisional income. Half the COLA amount, $560, gets added to the provisional income formula. More of their total benefit shifts into the 85% taxable zone. Additional federal tax triggered, approximately $57. Medicare Part B jumped ** 9.7% in 2026 ***, adding * $428 per year * for two people. Net benefit from the 2026 COLA raise, $635 per year, just $53 per month ***. The raise designed to protect retirees from inflation became a trigger that handed more revenue to the IRS. Every year, COLA rises. Thresholds stay frozen. The gap widens. More money flows to Washington. Hashtag inflation adjustment. What these thresholds should be. If the ** 1983 threshold of $25,000 * had been indexed for inflation like every other tax provision, it would equal approximately * $78,000 in 2026 dollars. The gap between what the threshold is * and what it should be * $53,000. If the * 1993 threshold of $34,000 * had been inflation adjusted, single filers would not enter the 85% zone until their income exceeded approximately * $72,000. Instead, they enter at * $34,000. These frozen thresholds represent the * largest stealth tax increase on retirees in American history, * achieved without a single vote, without a single headline, simply by doing nothing while inflation did the work. # Where legislation stands in 2026. Several bills have been introduced to eliminate federal taxation of Social Security benefits entirely. One current proposal would end the tax starting with * 2026 tax returns. As of today, that bill has not passed. The reason is straightforward. Social Security taxation generates approximately $45 billion per year in federal revenue. Eliminating it requires finding that revenue elsewhere, and no one wants to vote for the replacement. Instead, Congress created a partial Band-Aid, the senior bonus deduction, an additional $6,000 deduction per person, age 65 plus, available for tax years 2025 through 2028, phasing out at $75,000 for single filers and $150,000 for married couples. For our example retiree, this saves approximately $720 per year in federal tax. It helps. It does not solve the problem. And it expires after 2028. ## the 5 strategies to reduce your Social Security tax bill. ###. Checkmark. Strategy 1. Roth conversions during the gap years. This is the most powerful retirement tax strategy available, and it directly attacks the provisional income problem at its root. Roth IRA withdrawals do not count toward provisional income. They are completely invisible to the Social Security taxation formula. The optimal window, the gap years between retirement and the start of required minimum distributions, age 73 if born before 1960, or age 75 if born in 1960 or later. During those low-income years, convert portions of your traditional IRA to Roth at the lowest possible tax rate. The lifetime math. Converting $150,000 over 5 gap years at the 12% bracket equals $18,000 in conversion tax. Annual Social Security tax savings from Roth withdrawals, $2,133 per year. Break-even point, year 9. 25-year total Social Security tax savings, $53,325. Net lifetime benefit, $35,325 after paying every dollar of conversion tax. Every year you delay this conversion is a year of compounding savings you cannot recover. ###. Checkmark. Strategy 2. Strategic withdrawal sequencing. Even without full Roth conversions, the order in which you withdraw from different accounts controls your provisional income and your Social Security tax. The provisional income targets, below, $25,000, or $32,000, married, right pointing arrow, 0% of Social Security taxable. Below, $34,000, or $44,000, married, right pointing arrow, 50% zone, instead of 85%. If you need $15,000 beyond your Social Security benefit, pull from Roth or low-gain taxable accounts. Right pointing arrow, provisional income stays below thresholds, right pointing arrow, $0 Social Security tax. Pull from traditional IRA, right pointing arrow, provisional income crosses $25,000, right pointing arrow, $391 plus in new tax. Same amount of money, different account, hundreds to thousands of dollars saved every single year. Checkmark. Strategy 3. Qualified Charitable Distributions, QCDs. If you are age 70 and a half or older, and you give to charity, the qualified charitable distribution is the most tax-efficient tool available. Donate up to $111,000 per year, directly from your IRA to a qualifying charity. The donation counts toward your required minimum distribution. It does not appear in your adjusted gross income. It does not increase your provisional income. If you donate $5,000 through a QCD instead of writing a personal check, AGI drops by $5,000, provisional income drops by $5,000, potential shift from 85% zone to 50% zone. Annual tax savings on Social Security cascade, $500 to $700, asterisk. Checkmark Strategy 4, State Relocation Analysis. If you live in one of these asterisk 8 states that still tax Social Security benefits in 2026, Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, you are paying state tax on top of federal on every dollar of taxable Social Security. Moving to a no income tax state, Florida, Texas, Tennessee, Nevada, Wyoming, or a state that fully exempts retirement income, Pennsylvania, Illinois, eliminates that layer entirely. At $530 per year saved, over 25 years that is $13,250 over 25 years simply from where you live. Run the full cost-benefit analysis, including housing costs, healthcare access, and cost of living. For many retirees, the tax math alone makes it worth a serious look. Hashtag Strategy 5. Claim the senior bonus deduction and time your income. The asterisk $6,000 senior bonus deduction is available now for tax years 2025 to 2028. Age 65 plus. Single filer income below $75,000. Married filing jointly below $150,000. At the 12% bracket, $720 per year saved. Asterisk, at the 22% bracket, $1,320 per year saved. Combine this with intentional asterisk income timing, controlling when you take IRA withdrawals, when you realize capital gains, and how you sequence your income to keep provisional income below threshold boundaries in as many years as possible. Every year you stay below asterisk $25,000 as a single filer is a year of asterisk completely tax-free Social Security. The real numbers, what your benefit is actually worth. Scenario, annual Social Security. Gross benefit, 2026 average, $24,852. After Medicare premiums, approximately $21,937. After federal plus state tax, approximately $19,804. After cascade effect, wrong account, approximately $17,671. The hidden cap costs the average retiree $5,000 to $7,000 per year. Over a asterisk 25-year retirement, $125,000 to $175,000. Asterisk, taken from a benefit you spent a lifetime earning. Your 3-step action plan. Start today. Step 1. Calculate your provisional income right now. Asterisk. Take your adjusted gross income, right pointing arrow. Add any tax-exempt interest, right pointing arrow. Add 50% of your annual Social Security benefit. Compare your number to the thresholds. Below $25,000, $32,000, right pointing arrow, asterisk asterisk 0% taxable. Minus $25,000 to $34,000 single, $32,000 to $44,000 married, right pointing arrow, asterisk asterisk 50% zone. Above $34,000 single, $44,000 married, right pointing arrow, asterisk asterisk 85% zone. Step 2. Run the same calculation replacing IRA withdrawals with zero. Substitute any traditional IRA income with $0. Does your provisional income drop below a threshold? If yes, that dollar amount is the value of a Roth conversion strategy specific to your situation. Step 3. Check your state. If you are in any of the 8 states still taxing Social Security, calculate what that costs you over 10, 15, and 20 years. For many retirees, the number is larger than expected. Final thought. The Social Security system was designed to provide retirement security. But frozen thresholds, state-level taxation, Medicare premium deductions, and the provisional income cascade combine to create a hidden tax structure that most retirees never see until the money is already gone. The IRS will not call to tell you that you are overpaying. Your tax software will not flag the provisional income zones. Your Social Security statement will not show you the net after taxes and premiums. The only way to reduce this hidden cap is to take control of your own provisional income. Convert early, sequence withdrawals strategically, use QCDs, check your state, claim every available deduction before it expires. The system was not designed to inform you. Now you are informed. Always consult a qualified CPA or retirement tax professional before implementing any of these strategies. Tax laws are subject to change.